Welcome to Dr. Dan's channel. Today's story is not about conspiracy, it's about structure. Because there is a company most people have heard of, but almost no one truly understands. A company that does not manufacture products, does not lend money like a bank, and does not appear on ballots, yet quietly influences more of the global economy than most governments on Earth. That company is BlackRock. And to understand modern capitalism, how prices rise, why competition feels weaker, and why crises keep ending the same way, you have to understand how BlackRock became something entirely new. Not a bank, not a hedge fund, but a global ownership, governance, and financial coordination machine. What BlackRock actually is, and why that matters. BlackRock is the world's largest asset manager. To understand BlackRock's influence, we first need to grasp its sheer scale. As of early 2024, the firm manages over $10 trillion in assets. This isn't just a large number. It's a figure that redefines the meaning of financial power. It's a sum so vast it operates on a geopolitical scale, dwarfing the economic output of most nations. This figure hasn't been static. It represents a dramatic accumulation of capital, particularly over the last decade. The engine of this growth has been the seismic shift in investing itself. The move away from actively managed mutual funds and towards passive investment vehicles like exchange-traded funds, or ETFs. As investors, both large and small, have sought lower fees and market-matching returns, trillions of dollars have flowed into these passive funds. And BlackRock, through its iShares ETF platform, has positioned itself as the primary destination for that capital. It has both ridden and accelerated this wave, capturing a dominant share of a market that is fundamentally reshaping how the world's savings are allocated. To put that $10 trillion number in perspective, it is more than the combined gross domestic product of Japan, Germany, and the United Kingdom, the world's fourth, third, and sixth largest economies, respectively. Imagine the entire economic output of these industrial powerhouses for a full year, and BlackRock manages more. It's equivalent to roughly 40% of the total US GDP, the largest economy on the planet. For every $10 of value created in the United States, BlackRock manages 4. It is larger than all the physical US dollars in circulation. In fact, it's larger than the entire M1 money supply, which includes all physical currency, plus all the money held in checking accounts. It's a sum that exists on a different plane than the tangible economy we interact with daily. But here we must make a critical distinction. BlackRock does not own this money outright. This is not the firm's personal treasure chest. BlackRock is an asset manager. It acts as a fiduciary, a custodian. Its legal and ethical obligation is to manage this capital on behalf of its actual owners, in their best interest. It is an agent, not a principal. This separates it from a traditional bank, which takes deposits and makes loans from its own balance sheet, or a hedge fund, which often speculates with its partner's capital. BlackRock is a service provider, selling expertise, technology, and scale. So, who are these owners? Who are the clients that entrust BlackRock with this colossal sum? The answer is, essentially, the entire global financial system. Pension funds are a cornerstone of its client base. Consider a massive public pension system like CalPERS, which manages the retirement savings for over 2 million Californian public employees. To ensure it can pay out benefits for decades to come, it needs to generate stable, long-term returns on its vast pool of capital. By allocating a portion of its portfolio to BlackRock's low-cost index funds, it gains diversified exposure to thousands of companies instantly, a task that would be inefficient and costly to replicate on its own. Sovereign wealth funds are another key client. These are state-owned investment funds, often financed by revenues from a country's natural resources, like oil in Norway or the Middle East. Their goal is to convert this finite resource wealth into a permanent financial endowment for future generations. They turned to BlackRock to invest these billions globally, diversifying away from their domestic economy and accessing markets across every asset class. Insurance companies rely on asset managers to handle the enormous pools of capital they hold. An insurer collects premiums from policyholders and must invest that money, known as the float, so that it grows enough to cover future claims, whether from a natural disaster or a simple auto accident. BlackRock provides the sophisticated risk management and fixed income expertise needed to manage this float conservatively and reliably. Universities and other endowments use BlackRock to manage their funds to support scholarships, research, and operations in perpetuity. Even central banks, the stewards of national economies, are clients, using BlackRock for managing foreign currency reserves or for specialized advisory mandates during times of crisis. And finally, and perhaps most importantly, there are tens of millions of everyday investors. Anyone with a retirement account, a 401k, or a simple brokerage account who has bought an iShares ETF is a BlackRock client. Through these funds, the savings of teachers, engineers, doctors, and retirees are pooled together, making them collectively one of the most powerful forces in the market. This is the architecture of modern capitalism, a vast, interconnected web of ownership, with BlackRock sitting right at the center, managing the flows. Here is the crucial distinction most people miss. When you buy an index fund, you do not vote the shares. BlackRock does. And in capitalism, voting rights are power. To understand how control became so concentrated in our financial system, we need to examine two parallel, interconnected revolutions: the rise of passive investing and the mechanics of how our markets are wired. At the center of this story is a single transformative acquisition that took place in the shadow of the 2008 financial crisis. For decades, the dominant philosophy was active management. Armies of analysts and portfolio managers tried to beat the market by picking individual stocks they believed would outperform. It was a high-cost, high-stakes game. But a quieter, more systematic approach was gaining ground, one based on a simple, powerful idea. Instead of trying to beat the market, why not just buy the market? This is the essence of passive investing, and BlackRock's rise is inseparable from the rise of this powerful idea. The pivotal moment came in 2009. As the world was still grappling with the fallout of the global financial crisis, BlackRock made a bold move. It acquired Barclays Global Investors, or BGI, for $13.5 billion. This wasn't just any acquisition. BGI was a pioneer in quantitative and index-based investing, and with it, BlackRock gained control of a crown jewel, iShares, which was already the world's largest platform for exchange-traded funds, or ETFs. That acquisition quietly rewired global markets. It supercharged the shift of trillions of dollars away from active stock pickers and into passive index funds. By acquiring the premier platform for ETFs, BlackRock positioned itself as the primary toll booth for this massive capital migration. It created a gravitational center for passive investing, consolidating the infrastructure under a single corporate roof. To grasp the significance, we have to understand how these funds work. Most major indices, like the S&P 500, are market capitalization weighted. This means the larger a company's market value, the larger its share of the index. When you invest $1 into an S&P 500 ETF, more of that dollar automatically goes to Apple and Microsoft than to the 500th company on the list. This creates a powerful feedback loop. As more money pours into passive funds, the biggest companies automatically receive the most capital, which can further increase their market value and thus their weight in the index. It's a system that inherently concentrates capital and, as we'll see, voting power. Today, fueled by this dynamic and the relentless demand for low-cost investment options, BlackRock offers over 1,100 investment products through its iShares platform alone. The scale is staggering. Some of these single ETFs, which track broad market indices, each hold hundreds of billions of dollars in assets. They are financial titans in their own right, holding significant stakes in nearly every major publicly traded company. But the money in these funds doesn't belong to BlackRock. It belongs to millions of individual savers, pension funds, and endowments. This separation of economic ownership from practical control is the critical next step. Think about the owner of a few shares of an ETF. These retail investors don't attend hundreds of annual shareholder meetings for the underlying companies. They don't have the time or expertise to analyze complex corporate governance proposals. They don't vote on who should sit on the board of directors. They don't approve multi-million-dollar executive pay packages or weigh in on a company's climate strategy. The individual investor is, by design, passive not just in their investment strategy, but in their role as an owner. So, who does? BlackRock does. By default, the asset manager exercises the voting rights attached to all those shares, doing so on behalf of millions of disconnected investors. It does so efficiently, systematically, and automatically through its powerful stewardship teams and proxy voting infrastructure. And here is where the wiring of the market creates immense influence. Because corporate ownership is now so fragmented across millions of investors worldwide, the block of shares held by a single BlackRock index fund can be enormous. Even a 6 to 8% stake, which might sound small, often becomes the single largest and most decisive voting block in any given company. In a shareholder vote where most investors are absent, a block of this size is rarely challenged. Now multiply that power across thousands of companies, across every sector of the economy. BlackRock is simultaneously the largest shareholder in competitors like Coca-Cola and PepsiCo, in Ford and General Motors, in JP Morgan Chase and Bank of America. This isn't a temporary position, it's a structural feature of the market. The influence doesn't just add up, it compounds. It creates a web of common ownership that fundamentally alters competitive dynamics and concentrates unprecedented corporate governance power within a single entity. The scale of ownership. Across the entire economy, BlackRock is either the largest or second largest shareholder in roughly 495 of the S&P 500 companies. Not one sector, all of them. Technology, banking, energy, pharmaceuticals, consumer goods, defense. It doesn't need one company to win. When you own meaningful stakes in all competitors, incentives change. Less aggressive competition, more pricing stability, higher margins across industries. This is known in academic literature as common ownership. Markets still look competitive, but incentives quietly shift behind the scenes. What the research shows. Peer-reviewed economic studies have found that common ownership raises airline ticket prices by 3 to 7%, suppresses wage growth in concentrated labor markets, reduces price competition in banking and pharmaceuticals. When the same shareholders own all the players, competition becomes cosmetic, not eliminated, softened. The proxy vote mechanism. BlackRock casts votes at over 16,000 shareholder meetings globally each year. It votes on board appointments, CEO compensation, mergers, strategic direction, climate and governance policies. Most investors never opt out. So BlackRock's internal stewardship guidelines quietly become corporate policy across the economy. This is how power works without headlines. Aladdin. The system behind the system. Beyond the sheer scale of its assets under management, BlackRock wields a different, more subtle, and arguably more profound form of influence. This influence isn't just about owning shares, it's about providing the very operating system that a significant portion of the global financial industry runs on. To understand this, we need to look past the funds and into the code. Then there is Aladdin. And this is where BlackRock's influence moves from scale into something closer to control. If owning a large percentage of the market gives you a powerful voice, Providing the analytical brain for your clients, and even your competitors, gives you the power to shape the conversation itself. It's a shift from being a major player on the board to becoming the architect of the board itself. Aladdin, short for Asset, Liability, Debt and Derivative Investment Network, is BlackRock's proprietary risk management and analytics platform. The name itself reveals its ambition: to create a single, unified network that can see and analyze every component of a complex financial portfolio. From simple stocks and bonds to the most intricate derivatives, from assets to the liabilities they are meant to cover, Aladdin was designed to provide a holistic, real-time view of an institution's entire financial universe. It began as an internal tool in the late 1980s, a way for BlackRock to manage its own risk. But its capabilities were so powerful that the firm realized it had another, even more scalable product on its hands. On paper, it is a tool. In reality, it is financial infrastructure. A tool is something you use. Infrastructure is something you depend on. A tool can be easily swapped out. Infrastructure becomes deeply embedded, connecting disparate parts of an ecosystem and creating powerful network effects. Over decades, Aladdin has transitioned from the former to the latter. It has become the technological plumbing for a vast segment of the investment world, a centralized nervous system processing immense flows of information. So what does it actually do? At its core, Aladdin is a suite of sophisticated software modules. Its risk management module allows a portfolio manager to run complex stress tests, simulating how their holdings would perform in thousands of hypothetical scenarios: a sudden interest rate hike, a geopolitical crisis, or a commodity price shock. The liquidity module analyzes how quickly assets could be sold without crashing their price. Other modules handle portfolio construction, compliance monitoring, and even the routing of trade orders. It provides a common language and a common analytical framework for its users, from the front office trader to the back office compliance officer. This service is delivered primarily as a hosted solution, what's known as Aladdin on the cloud. Clients don't install the software on their own servers. Instead, they connect to BlackRock's massive data centers, where the platform is maintained, updated, and run. This software as a service model ensures that every client is using the same version, the same models, and the same underlying data architecture, which is a critical point we will return to. The scale is staggering. Aladdin monitors and models over $21 trillion in assets globally. To put that number in perspective, it's more than double the nearly $10 trillion that BlackRock manages itself. It's an amount roughly equivalent to the entire annual economic output of the United States. This means that the financial health and risk exposure of a vast portion of the world's managed capital is being tracked, analyzed, and interpreted through a single proprietary system. And who are its users? The client list is a roll call of the most systemically important players in finance. It is used by pension funds, who manage the retirement savings of millions of teachers, firefighters, and public employees. Major banks, who use it to manage their own investment portfolios and assess risk. The world's largest insurance companies, who must carefully match their long-term liabilities with their assets. Sovereign wealth funds, which manage the national wealth of entire countries. Even central banks have turned to BlackRock's analytics in times of crisis. And perhaps most tellingly, it is used by rival asset managers, BlackRock's direct competitors, who have decided that the benefits of using the platform outweigh the risks of relying on a competitor's technology. This widespread adoption of a single technological platform, a single way of seeing and interpreting risk across so many different powerful institutions, creates two unprecedented realities. First, systemic synchronization. When institutions rely on the same risk models, the same stress tests, the same assumptions, they react to shocks in the same way. Not because they are told to, because the model tells them the same story. This amplifies volatility and narrows decision-making. Second, informational asymmetry power does not come from trading faster. It comes from knowing how everyone else is positioned before prices move. Aladdin reveals correlations tightening across portfolios, liquidity thinning simultaneously, risk thresholds aligning across institutions. When that happens, outcomes become predictable. Not through commands, through convergence. No private institution in history has ever had this level of market visibility. A quiet duopoly. At this point, it's worth briefly mentioning Vanguard. Vanguard often appears alongside BlackRock as a top shareholder in the same firms. But there is a difference. Vanguard manages assets. BlackRock manages assets and the operating system. Vanguard owns shares. BlackRock owns the dashboard. When markets break, governments call BlackRock. During crises, governments don't call hedge funds. They call BlackRock. In 2008, BlackRock helped unwind toxic assets. In 2020, the U.S. Federal Reserve hired BlackRock to execute emergency bond buying programs, including ETFs BlackRock itself managed. That made BlackRock a market participant, a market stabilizer, and an agent of the central bank, legally allowed, structurally extraordinary. The Revolving Door BlackRock executives regularly move into treasury departments, central banks, economic advisory roles, and back again. This is not unique, but at this scale it matters. Policy familiarity becomes policy influence. Why this is historically new: Standard Oil controlled oil, JP Morgan controlled banking, IG Farben controlled chemicals. BlackRock influences ownership itself. It does not set prices directly. It does not manage companies. It votes. It models risk. It shapes incentives. And because asset management is treated as neutral intermediation, traditional antitrust law struggles to even see it. Who benefits? And who pays beneficiaries? Asset managers, large corporations, shareholders benefiting from stable profits. Costs are diffuse. Consumers face higher prices. Workers face weaker wage growth. Small firms struggle to compete. Democratic accountability thins, no villain required, just incentives. Where this is headed. Passive investing continues to grow. Index funds already control over half of U.S. equity assets. Ownership concentrates. Voting power concentrates. Decision-making narrows. The question is not whether BlackRock is powerful. It is whether this structure is compatible with competitive capitalism and democratic governance over the long run. Final reflection. BlackRock did not set out to own the world. It followed incentives the system created. But the result is unprecedented. A single firm influencing nearly every major corporation through ownership, data, and governance. Without issuing orders or breaking laws, once you see the structure, you cannot unsee it. And understanding it is the first step toward deciding what kind of economic system we actually want to live in. If this analysis helped you see the system more clearly, subscribe to Dr. Dan's channel for calm, long-form breakdowns of the forces shaping our world. Like the video if it sharpened your thinking, and share it with someone who still believes markets are just chaos. We'll keep unpacking the structure, one layer at a time.